What is going on, y'all? This is Pay Me in Dividends, and today is January 8th, 2025. Now, before we jump into the video, let's go over my portfolio very quickly. I am at $89,391. My current holdings have remained the same. I have 1,000 shares of AIPI, 1,000 shares of MSTY, 100 shares of NVDY, and 200 shares of RDTE. Now, what I want to talk about today is how to invest into high yield dividends as a beginner, right? So this will be sort of a tutorial, sort of a quick guide to give you an idea of how you can start off investing into high yields, right? So I have a couple points that I want to go over here. And the first one I want to start off with is when you start this high yield journey, personally, this is not financial advice, but personally, I would suggest that you start off indexed. What do I mean by indexed? Well, what I mean by that is finding dividend ETFs that track an index such as the S&P 500 or the NASDAQ, right? So we're going to go over this very quickly, and I want to give you guys some examples as well so that you have a better understanding of exactly what I'm trying to say here. So first of all, we'll look at S&P 500, right? This is the S&P 500. As we all know, the S&P 500 tracks 500 of the biggest companies on the U.S. stock market. And we also have the NASDAQ, which tends to be a bit more tech heavy and is an underlying index, sort of like the S&P 500. And the NASDAQ and S&P 500 are both pretty much the standard for where the market direction is going to go moving into the future. Now, why is this important, right? Because when you're tracking an index, you have a basket of stocks that are weighted in a way where if one is underperforming, the ones that are performing well are able to carry that weight. And so you're not just relying on one particular stock or one particular company, but you are by default diversified because you have your money into an index. Now, I want to give you guys an example of that, right? There are investments from Neos, and they have a suite of investments here that track each underlying index. So the first one I want to take a look at is SPY-I, right? So SPY-I tracks the S&P 500, right? So if we look at their strategy, the fund seeks to distribute high monthly income generated from investing in the constitutes of the S&P 500 index and implementing a data-driven call option strategy. So not only are they providing a monthly yield, but they're doing it by tracking the underlying index, which is the S&P 500 in this case, which automatically makes you diversified, right? And I feel like this is important when you start off, because when you're first starting off, you don't want to have a concentrated position in one particular asset. You want to build that foundation out first, right? And so for my portfolio specifically, the reason why I have the most amount of equity in AIPI is because they don't technically track an index like S&P 500 or the NASDAQ, but they do have a basket of different companies that are in this fund that makes it diversified by nature, right? They have Palantir, they have NVIDIA, they have a bunch of different tech and AI companies. And so they, by nature, they are diversified, and so you're able to build a better foundation that way, and you're able to avoid some of the swings that come with some of these individual companies. If a company drops down 20% or even more within a day, which we've seen before with super microcomputers late 2024, they dropped over 20% within a 24-hour period. If you had all your money in that one single stock, your portfolio would have been down a lot, as opposed to having your money in an indexed ETF where the swings are not as dramatic. So I hope this is making sense, right? Again, this is a fundamental, foundational step so that you have a strong foundation in your portfolio, especially when you're first starting off with these high yield dividends. So that was the first one I wanted to look at. I want to give you some more examples from Neos, right? Because they have an entire suite of ETFs that track each major index. So the first one we looked at was SPY, which tracks the S&P 500. The next one I want to look at is QQQI, which tracks the NASDAQ, right? So they implement the same strategy they do with SPY, except on this one, they do it with the NASDAQ index, right? Now, they also have another one where they track the Russell 2000, right? This one is IWMI. And again, they implement the same strategy that they do with SPY and QQQI, except on this one, they do it based on the Russell 2000 index. So again, these are just a few examples that you can look into so that you are automatically diversified into an index instead of putting all of your money into one individual stock or one individual company. I want to give you guys another example as well from JP Morgan, JEPQ, right? As you can see in the name, JP Morgan NASDAQ Equity Premium Income ETF. If we go down here, we can see that JEPI is an income ETF that seeks to deliver monthly distributable income and NASDAQ 100 exposure with less volatility. By nature, these are going to have less volatility because, again, you are automatically diversified into an index. So I wanted to start off with that just to give you guys a foundational play that you can build your portfolio out of so that you have less volatility and you have better long-term performance. Now, the next point I want to talk about is diversify, but do not spread yourself too thin, right? Warren Buffett even has a quote, not verbatim, but I'm paraphrasing here, but he says something along the lines of, if you diversify too much, you pretty much don't know what you're investing into, right? So he likes to concentrate his positions, which is a strategy that I like to use personally in my portfolio. If you notice, I only have 4 positions, right? And I have a good amount of equity in each one. And the reason I'm doing that is because I want to have concentrated positions. I don't want to have 1 share here, 3 shares here, 7 shares here. I want to take my time, even if it takes months or years, to build out every position that I believe in long term in order to really concentrate that position so that I can extract as much cash flow on a monthly basis as possible. So yes, I do suggest that you diversify, but don't diversify so much that you spread yourself thin. I would suggest choosing anywhere from 5 to 10 different stocks, put them on your watch list, 5 to 10 different dividend ETFs, put them on your watch list, and then choose one at a time that you want to build out a position into and go from there. All right, so that was the second point I wanted to touch on. So again, we're starting off indexed, S&P 500, NASDAQ 100, Russell 2000, and also diversify, but don't spread yourself too thin. Make sure you have a decent amount of equity in each position so that when you get that monthly payment from that dividend ETF, it's worthwhile, right? It feels like you're receiving a paycheck, right? So you want to diversify, but you don't want to spread yourself too thin. Now, the next point I want to talk about is reinvesting all of your dividends, especially in the beginning in order to accelerate the compounding effect. I believe once you start investing into these high yield dividends, it could feel you could feel pressure to take out some of those dividends, because when they hit your cash account, you see, oh wow, I've received $100 or $50 or $300 or whatever the case is, and it might be tempting to take that money out and go spend it. But here's the thing: if you continue to reinvest those dividends while you also continue to contribute your own money to your brokerage account, over time, the compounding effect is going to accelerate, because now not only are you contributing your own money to your brokerage account, but you're also reinvesting the dividends, which is now buying you more shares of these cash producing assets. So I do think reinvesting dividends is probably one of the most powerful tools that you have in your arsenal when it comes to a high yield portfolio. Because look at it this way, right? In real life, you may have some weeks or months where you can't contribute your own money to it, right? We all have bills, we all have real things that we have to take care of. So there may be points in time where you cannot take money from your paycheck and put it into your brokerage account. However, if you have that monthly cash flow of dividends coming in and you're constantly reinvesting, even if you do miss an opportunity to put money in your brokerage account, you still are buying more shares because your dividends are buying more shares. So it's helping you generate more money. It's helping you generate more cash flow. It's helping you buy more shares, and you can double down when you put your own money into your brokerage account and when you reinvest the dividends as well. So that's something I would really suggest, is not to get tempted into taking out your dividends when you see them hit your account. I know it can be tempting. It's a really, really good feeling when you see that passive income hit your account, but just remember to have a long-term mindset when it comes to this type of investment. And when it comes to any investment, right? High yield dividends is no different than any investment. You have to almost look at your portfolio as a business. When businesses first start off, if they take all of their revenue out of the business and go spend it on frivolous things, they're never really going to be able to scale their business and really get the full potential out of their business. Most businesses in the beginning stages, within the first few years, reinvest every single dime back into the business in order to scale it, and so that eventually they can become profitable, and then they can take money out and put it into other things. But I would highly, highly suggest in the beginning, and when I say in the beginning, I'm talking about the first 3 to 5 years minimum, because again, this is a long-term game. You should look at yourself as a lifelong investor. This should not be looked at as a 6-month game or a 1-year game. This should be looked at as being a long-term investor or a lifelong investor. So within the first 3 to 5 years minimum, you should be reinvesting every single dime that comes into your account as far as dividends, right? So again, I just want to touch on those three. I think these are the most three important in the beginning, is starting off indexed, diversifying but not spreading yourself too thin, and then reinvesting all the dividends, right? So again, here are some suggestions that we already went over, right? SPY, QQI, IWMI from NEOS, GPIX is from Goldman Sachs. This one tracks the S&P 500, and JEPQ from JP Morgan, which we already took a look at, tracks the NASDAQ 100, right? Now, finally, I want to talk about single stock ETFs, right? Now, as this says, right, only invest into single stock ETFs if you truly understand the underlying asset. Now, I want to give you guys 2 examples, and the 2 examples I'm going to give you are 2 stocks that I hold, right? MSTY and MVDY from YieldMax. And I'm going to explain to you my thought process behind the reason of me putting money into it and investing in it, so that you get a better understanding as to why I put my money into it and why you really have to be intentional when you're investing in single stock dividend ETFs, because they can pay off, but you have to make sure you understand why you're investing into them, right? So the first one I want to look at is MSTY. Now, as we know, MSTY is from YieldMax, and it is a option income strategy ETF based off of MicroStrategy. Now, let's take a look at MicroStrategy, right? MicroStrategy is a tech company, they're a cloud company, but the biggest thing that MicroStrategy has on their side is their accumulation of Bitcoin. Now, there's actually a website here that shows how much Bitcoin MicroStrategy holds. MicroStrategy is in the top 10 Bitcoin holders in the world, right? So as of today, they hold $42 billion worth of Bitcoin. And I like this website. It's called sailortracker.com, and it actually shows you every time MicroStrategy purchases Bitcoin. So if you go down here, you can actually see each date that they purchase Bitcoin, with their most recent purchase being on January 6th. And it looks like they purchased about 1,070 Bitcoins on January 6th. Now, why is this important? For me, it's important because I believe in Bitcoin long term. It's performed very, very well since its inception. And I believe over the long term, there will be ebbs and flows, there will be ups and downs. But over the long term, Bitcoin, I believe, will continue to rise in price. And so this is the reason why I'm investing in MSTY, because it's sort of, MicroStrategy is sort of a proxy of Bitcoin because of its heavy correlation to Bitcoin. Now, I'm not telling you to invest into MSTY. What I'm telling you is my reason for investing into it and my understanding of how the price movement on this particular stock works and its correlation to Bitcoin and my belief in Bitcoin. Now, you may or may not be into crypto, you may or may not believe in Bitcoin, and that's completely fine. I'm not here to try to convince you, but what I am telling you is that you need to find a reason to believe in the thing that you are investing in, right? And this is why I started off saying to start off indexed, because when it comes to an index like the S&P 500 or the NASDAQ, there's not much research that's needed to go into it because it's already diversified for you. But when you begin to go into the single stock ETFs, that is when you really have to do your due diligence and understand exactly what you're putting your money into. And if you cannot explain to yourself why it is you're investing into a particular individual stock, then you're better off just staying in the index in order to mitigate any risk. So I hope that's making sense, right? I want to give you guys one more example, and this is another stock that I own, which is NVDY, right? So NVDY is an option income strategy based off of NVIDIA. Now, as we know, NVIDIA is a beast, right? They are an industry leader. Their profit margin is insane. The most profitable, the highest generating revenue companies in the world, like Apple, Microsoft, Google, companies like this, Amazon, their net profit margin are mostly under 25%, anywhere from the 15 to 25% range, which is still very, very good. If we take a look at NVIDIA, their net profit margin is over 50%. Over 50% of the revenue that they generate is net profit, which is insane. And I believe NVIDIA moving forward into the future is only going to generate more revenue, and they're only going to become a bigger and bigger, right? So I believe in NVIDIA long term. NVIDIA as a stock has performed amazing. They gained over 170% just in the year of 2024. And so this is the reason I'm invested into MVDY. So again, guys, I'm giving you my reason as to why I invest in these stocks. I'm not telling you to invest in these stocks, but what I'm telling you is to make sure you understand what you're putting your money into. And the same way I'm explaining to you my reason for investing into these stocks is the same way that you should be able to explain to yourself. Because listen, you're going to work, you're making money, you're trading time for money, you're working hard for your money. The last thing you want to do is take your hard-earned money and just throw it into any stock that you don't really understand, and then long term it underperforms, and then now you're angry, you're resentful, and you feel some type of way because your money did not perform the way that you wanted it to perform due to your lack of research, right? So I'm encouraging you guys to do your due diligence, do your research. Nvidia could fail in the future. Bitcoin could fail in the future. But at least I know at the end of the day, I did my research, I did my due diligence, and I knew exactly what I put my money into before I invested that money. So again, guys, I'm encouraging you to watch videos like this, do research, read articles, go on Google, do whatever you need to do, but make sure you have a deep understanding. It doesn't have to be too crazy of an understanding, but make sure you have somewhat of an understanding of what it is you're putting your money into before you begin to invest. So let's just do a quick rundown real quick, right? And actually, before we do that, I want to show you guys this tracker, which I've showed in other videos as well. But this is basically a tracker that I've made just for personal use in order to keep my mind active, and whenever I fall off the path, I'm able to go back here and redirect and remember what kind of funds are out there and what exists, so that if I do plan on adding something in the future, I have a reference point, right? So here you can see I have hyper yield, anything that's producing 25% or more dividend yield. Right here, I have indexed ETFs, right, which is what we talked about before. So you have JEPQ with the NASDAQ, you have SPY with the S&P, so on and so forth, right? So you have plenty of different options to choose from, and these right here are amazing to start off with and build your foundation, because again, it's based off of an index, so you don't have to worry about doing too much research on a particular company like Netflix or Nvidia or MicroStrategy, unless you're really interested in these companies and you have an understanding of how they make money and their revenue and how profitable they are. Then you can jump into these. But again, if you're just starting off, I would suggest staying within the index, building out that portfolio. That way you have a strong foundation, and then you can diversify from there. So again, let's just do a quick overview. Start off indexed, right? Diversify, but don't spread yourself too thin, right? Make sure that you are concentrating your positions so that you don't have a small amount of equity spread out between 100 companies. You would rather have 5 to 10 companies or 5 to 10 dividend ETFs that are concentrated in equity, so that you're really able to generate those nice monthly paychecks for yourself. The third thing, again, reinvest all your dividends, especially in the beginning. Here's a list of suggestions that we already went over. And then lastly, only invest into single stock ETFs if you understand the underlying asset, right? So again, start off indexed, diversify, but don't spread yourself too thin. Reinvest all of your dividends, and only invest into single stock ETFs if you understand the underlying asset. And another thing, finally, and I think the most important point here, is to have a long-term mindset. I've spoke to so many people in real life who ask me about stocks and how to invest, and it seems like a lot of people are very short-sighted and are looking to get rich quick. And I've met so many people who are looking to get rich quick. For the past 30 years, they've been looking to get rich quick. And for some odd reason, they've never gotten rich. You see how that works? So you have to have a long-term mindset. This is a long-term game. You have to be consistent. You have to be disciplined. You have to have patience. And most importantly, you have to have fun with it, right? So have a long-term mindset, start off indexed, and then spread out into the single stock ETFs like Misty or MVDY once you actually have an understanding of how these companies operate. So I hope this guide helped you guys how to invest into high yield dividends as a beginner. If there's anything that I left out or if there's still any confusion, please let me know in the comments. I really enjoy when you guys ask questions. This gives me new ideas for videos, and it also I like feeling helpful to the team that we have here on the channel when people are asking questions, because that means you guys are engaged. That means you guys care about your financial well-being, and that means that we're going to get this money together, right? So I'm on this journey with you guys. You guys are on this journey with me. And again, I appreciate the questions. You guys let me know in the comments. What do you think? What are some suggestions for the other viewers of dividend ETFs that they could start off with if they're just starting a dividend portfolio? So as always, guys, I'm super grateful. I appreciate you guys stopping by the channel, and I will catch y'all in the next video.